Hi, welcome to the CIDCI Online Salon Series. I'm Margie O'Driscoll, and on behalf of the CIDCI Board of Directors, I'd like to welcome you here today. CIDCI's mission is to accelerate change in the built environment by convening innovators for educational programs. We also serve as a trusted source of information about innovation. Special thanks to our sponsors who make all of this possible. Today, as wildfires sweep Northern California and hurricanes batter the Gulf Coast, on top of long simmering social unrest and a pandemic, it's easy to feel overwhelmed. We want to remind everyone to take care of themselves, their families, and colleagues. Be patient with yourself and others. These are truly unprecedented times that try our souls. Today, we feature Brian Sayre from Shadow Ventures in discussion with CIDCI board member Zig Rubel. A bit about Brian. He's a senior associate with Shadow Ventures, having worked with over a dozen Fortune 500 companies, including Cigna, General Mills, and Chick-fil-A. He's seen a range of corporate venturing models, some that work better than others. Brian is joining us from Atlanta. Brian, please take it away.
Thanks for that awesome intro, Margie. And happy to be here this afternoon speaking with everybody. Corporate venturing, corporate innovation has been a passion of mine for a number of years now. And since joining Shadow Ventures almost a year ago now, kind of seeing the uptick in interest in corporate venturing among the AEC firms, I think has been a really positive thing for the entire industry. And so what is corporate venturing? Is it just a cool new innovation buzzword? Well, kind of, but I think in a simpler definition, it is a way for corporations to not only receive the strategic value of engaging and working with startups, but it's also a way for corporations to receive financial value from those type of relationships. We've seen corporate venturing as a corporate development practice used by the big tech giants for decades now. It's had its ebbs and flows, it's come and gone, but it's pretty mainstream right now among most of the big Fortune 500 companies throughout the space. And what we continue to observe is smaller firms and a more diverse group trying to get involved with this practice as well. So what I want to cover today is, you're kind of aware of what it is. Maybe your firm is interested in partnering with startups in a more strategic and financially incentivized way. But how do you actually get started? What's that first step that you need to take? And what do some of the different models potentially look like? Who is Shadow Ventures? What are we? So at its core, Shadow Ventures is a seed stage venture capital firm. So we exclusively invest in the built environment. So any early stage startups, they're typically pre-revenue or very early revenue. So that's a typical definition of around where a seed stage company is. Typically about 2 to 3 startups. And we invest across the entire built environment. So whether it's design, build, operate, and increasingly we're looking at feasibility. Our firm was founded by KP Reddy. He's a serial entrepreneur in the space. He was a civil engineer from Georgia Tech and was working a lot with corporate spinouts. So helping internally developed corporate startups spin out of the corporate environment and scale away from the corporate structure. And that was kind of the origin stories of how Shadow Ventures began. Right now, we're in the process of closing our third fund. It's been about a year-long process, but thankfully at the end of August, that is going to be closing. So we're actively in deal mode right now, looking for startups to invest in, and again, across the entire built environment. We actually just closed our first investment last week in a Canadian-based company called Local Logic, and we have a few other deals that are currently in our pipeline right now that we're excited to announce here shortly. Beyond Shadow Ventures, we also operate a lab program called Shadow Labs. That is global in scope. It's virtually operated, and it's been around, and it was established that way intentionally 3 years ago. And currently within that, there's over 80 startups. These are typically pre-seed companies. What Shadow Labs allows us to do is really build a relationship with those founders, get a strong understanding of their technology and the problems they're trying to solve, and then figure out when they're ready, if we could potentially be an investor in them. Some of our past investments, I just mentioned Local Logic, but from our previous funds include Icon, the 3D printed housing company, and then Amenify, which works in multifamily around providing amenities to the different residents. Just a quick background on myself. I won't bore you guys too much on this because it's not too exciting. But I currently work at Shadow Ventures and help manage our corporate relationships. So about half of the people that are LPs or limited partners in our newest fund are strategic investors. So it's large engineering firms mostly. And what they're looking for in terms of a relationship with Shadow is not only the financial value that we provide from venture capital investing, but also strategic value. So how can they work with startups to solve challenges that they're observing or capitalize on new opportunities that they're seeing? And so I kind of act as the gatekeeper between those two sides. So funneling startups that we think are strategically relevant to those corporations, and then the corporate funnel startups back towards us that they think we might be interested in looking at. I come from a background of corporate venturing and corporate innovation. The company I worked with in the past was called Vinidar. And we worked with companies like Cigna, General Mills, and Chick-fil-A, helping them kind of get their corporate venturing set up, get their best practices set up, and create kind of the structure so that they could get started on this road. I mentioned this before, but I'm extremely excited to see the level of enthusiasm across the entire AEC space, and firms increasing excitement and willingness to partner with startups. And I think there's some really great opportunity for all of the firms within this space to help accelerate the adoption of new technology within our tech nascent industry.
So Brian, I wanted to ask you a couple of questions before you got into the depth of the presentation. Is the presentation for entrepreneurs, investors, or both?
This is mainly for investors, and investors that are in the corporate setting.
Right, I see. And what's in the name Shadow?
So I actually had to check on that story this morning because I saw that question. And believe it or not, it's actually from a conversation that our founder KP was having with Ludacris and Ludacris's manager, Atlanta-based guys, and they were talking about KP is always in the know of what's happening in the space, but kind of in the background of all of that. And that's very much how Shadow operates. A lot of the deals that we find are not your mainstream VC deals that you see a lot of others looking at. We're really good at kind of operating the shadows and finding those companies that others aren't seeing.
Okay, that's good to know.
Yeah.
What makes you excited about the AEC industry, given that you come from the corporate investing side of the world?
Yeah, so I actually grew up in the construction space. My family owns a residential HVAC company down in South Florida, and a lot of the technology practices and processes that I grew up observing that my family was using are still being used today. I think everybody knows this, and it's said on pretty much every panel discussion you'll hear people talk about, is how tech nascent and how far behind the entire AEC industry is in adopting new technology. That's why I think that's why it's great that there's groups like this that are trying to figure out how can you push innovation forward and accelerate adoption. There are a ton of barriers to that happening within the entire industry that are pretty well established. And I think corporate venturing with the financial upside of investing offers some solutions that could make it a little more appealing to a larger audience.
Okay, well, I don't want to ask any more questions right now, but please tell us more.
Awesome. All right. So let's talk a little bit more about why I think corporate venturing is a really strong structure for AEC firms to pursue. And what I commonly refer to it as is it creates a flywheel effect. So what do I mean by that? With a lot of the startups that we work with, and I'm sure a lot of you experience this as well, you are the target customer of the startups that are entering the space. The startups are developing technology solutions for architects, for engineers, for general contractors to use that will hopefully help you save money, create more efficiencies on your job sites, accelerate timelines, and just across the board help you operate more efficiently. So if you're the target customer of these startups, what that does for them is, first of all, it creates tremendous value in terms of their valuation value. if a firm the size of some of the sponsors that I saw on this forms a commercial agreement with the startup at the stage where we work, $1 in terms of commercial revenue can have as much to a 5 to 15x increase on that tech company's valuation. So if you invest or if you form a $100,000 commercial contract, that could have anywhere between a $500,000 to a $1.5 million impact on that company's actual value at any given time. So if you form the commercial relationship, which many of you do with startups, you're getting the strategic value. And what the strategic value is you're getting whatever that commercial agreement implies and whatever value proposition that startup has pitched to you, you hopefully gain that through that commercial relationship. What you are missing from just doing the commercial relationship is the financial upside of the valuation value that you create if you would have invested in that company. I always like to use this as an example, but how many of the attendees on this call were early adopters of technology like Autodesk and Procore and Trimble? You were early customers that validated these companies. You helped create billion-dollar multinational corporations, yet you saw zero financial upside beyond what you got from the commercial relationship with those companies. We're seeing a lot of capital go into startups in the built environment. And now is a time for you to kind of look at what's coming up next. Who's the next Autodesk? Who's the next Procore? And how can you potentially gain equity in those companies? Slide 6 just kind of shows the flywheel in effect, but in a little bit more of a graphic representation. So, after any sort of diligence has been done with the deal, the way it typically works, or the way it works, is it creates a self-sustaining innovation model. Innovation is expensive, and a lot of times pursuing innovation goals goes against revenue and growth goals of a company short term, because it costs money to pursue innovation. There's risk associated with innovation. All of these things are barriers to companies being able to adopt innovation more readily. So the way it typically looks is, if you invest in a strategically relevant startup, you then form a commercial relationship with that startup. And in doing so, you're doing two things. The first is you are increasing the value of that startup in terms of what their actual valuation is. And the second is you are also validating that startup to the broader audience. So if you're a general contractor and you start working with a startup and you form a commercial relationship with them, that startup can now go to other general contractors and say, I'm working with Joe's Contractors. This is the relationship I formed with them, and here's the proof of concept and the value that I've created for them. And in doing so, hopefully their customer adoption continues to accelerate. So by you forming that early relationship with them, you're very much validating that technology and signaling to the rest of the market that, hey, this works, and yes, we're bought in on it. The next step is you exit the startup. So you either the company goes public, the company gets sold, or you sell your position within that company. Hopefully, when you exit, you've realized some sort of financial returns from that, which can then be used to reinvest in more innovation pursuits. So whether that's reinvesting in more startups, whether that's funding some of your own internal innovation practices, or whether that's helping you form new commercial relationships with more startups within the space.
So I just had a couple more questions. What is corporate investing not ideally suited for?
I think when you start to get outside of strategic investing is when a lot of corporations will get in trouble. So if you are a general contractor and you're doing corporate venturing, you should be investing in startups that you can form a commercial relationship with. You shouldn't necessarily be forming a commercial relationship with a startup or investing in a startup that has a solution for multifamily tenant experience. It's too far disconnected from your core business, and it should somewhat be aligned to what your company is trying to achieve.
So are there any notable traditional AEC firms that have benefited from the flywheel effect, or is it only technology companies that benefit from this approach?
Yeah, definitely. So, I think there's kind of two different categories that I've observed. The first is kind of your incumbent, a lot of the building product manufacturers and the technology companies, Bosch, Schneider, Hilti, Gerdau, Saint-Gobain, Dow, Procore, they all have corporate venturing teams. And those very much resemble kind of what we see more so in the traditional corporate venturing strategies. They have very large dedicated funds that are going out and investing in startups. On the AEC side, we work really closely with companies like Thornton Tomasetti, which is a LP in our fund. Swinnerton, I know, has a really strong established process. Suffolk, I think, has one of the more sophisticated corporate venturing practices I've seen from general contractor sides. WGI is another great one down in South Florida. And then there's, even on the corporate development side, groups like OCV, which is part of CIM Group, and then CBRE, both have really well established corporate venturing practices established.
All right, great. Thank you.
Cool. All right. So what are some considerations that we should look at within corporate venturing before kind of we jump into this? The first is corporate venturing is still investing. So there is always risk associated with any type of investing. And no matter how many I's you dot and T's you cross and how careful you are, there are always going to be external factors that you cannot control. So you have to go into that understanding that investing is risky, venture investing is riskier, and you can de-risk that by being a strategic partner with those companies. The second is one size doesn't fit all. There is not going to be a single slide in this that you can just take to your executive team and go, here you go, this is exactly what we should do. Corporate venturing should always be structured to fit within the ecosystem and the structure of your company. The third is defining your mission, vision, and purpose up front is extremely important. There's going to be a lot of very tempting startup distractions that pop up that you might want to go pursue. But if it doesn't align with the purpose of why you originally set up that group and what your investment strategy is, you're not going to be successful with it. The fourth is getting buy-in from your leadership team. This is absolutely vital to the longevity of any corporate venturing strategy, and setting realistic, measurable goals that you can continue to hit and achieve is extremely important. So that can go beyond just financial returns, and it should. It should look at things like accelerated timelines, dollars saved, efficiency gained, and all these other different measurables that you can put in place that you can go back to your leadership time and time again and say, this is exactly what we've done, and we are hitting our goals that we set forth through our corporate venturing practices. I'm going to run through just kind of a few of the different high-level models that I've seen within this space. And I'll make sure to also point out which ones are most relevant for this audience. This first one is probably not the most relevant for this audience, and that's launching a dedicated fund. And so what that is it is going to be the most aggressive strategy in terms of the financial commitment, the time, and the resources. On the upside, it also offers the most potential return from a financial perspective. Within this model, typically what happens is a corporation sets up a separate entity and dedicates a certain amount of money to that to invest in startups. And the structure of that very much looks like a typical venture capital firm. So like as an example, when I was working with Cigna, they had set up a $250 million fund that they were going to invest in startups over 5 years. With that $250 million, they were looking at much later stage companies that Shadow looks at. They're looking at companies that are Series B, Series C. Typically those types of companies have very strong existing revenue. They're showing very strong growth. Their technology is established, and that capital is strictly going towards helping them grow. Fully understanding that not every company has $250 million to dedicate towards corporate venturing. This is typically something that you want to try to grow into. Within this model, the corporate is the single general partner and is the only investor. So within Shadow's fund, for instance, we have one general partner who's our founder, KP, and then we have several limited partners that all contributed towards the fund and have certain rights with that. When you're setting up this sort of model, typically it's best to hire someone from outside. You're going to want to hire somebody that has experience from the venture capital world, knows how to run, knows how to source deals, and knows how to manage a fund to generate the financial returns that you'd expect. And typically this person is going to report to somebody like the CFO, the head of corporate development, and a lot of times the CEO directly. Again, I typically recommend that this is something you build towards, and it's probably not the best of the models for this audience that we're speaking with today. The last kind of caveat on this is there is an opportunity to partner with a venture firm and still have a dedicated fund. Shadow's first two funds were actually set up this way. They were single LP funds directly tied to a corporation. So within that, the benefit is that you are gaining the expertise and guidance of an experienced venture firm to manage all of your investing. So you don't have to go out and hire somebody. And it's also going to be 100% strategically aligned with your corporate goals. The downside of that is with any venture capital model, there are fees associated with it. And it typically resembles the 2% management and the 20% carry structure. So looking at a little bit more actionable, opportunities for this group to pursue. Slide 9 talks about strategic investing. So what we're looking at there is it's going to be your least aggressive strategy. It also offers the least amount of financial upside, but that's because you're not actually putting dollars behind the company that you're investing in. Rather than investing capital in startups, you're investing time and resources. Typically what that looks like is alongside any sort of commercial agreement, your company would earn warrants or convertible notes that after certain milestones are reached, convert to equity in that company. Typically, if you're going to look at this sort of strategy, you're going to want to look at very early stage companies. So those that are pre-seed and seed stage, because they're going to value this sort of arrangement more than somebody that's more established. It's very important to set very clear KPIs that clearly define what success looks like in this. And it's also really important to get buy-in from the teams that are actually going to be working with that startup. So if you're a general contractor and your project manager is going to be the one using and working with that startup, making sure that they are 100% bought in on that commercial agreement is absolutely essential to making sure that it's successful and that the warrants and convertible notes actually eventually kick in. And the biggest challenge with this is actually going to be getting buy-in from the startups. If they're going to be giving up any sort of equity in their company, the value that you're creating for them is going to have to be pretty substantial to get their buy-in. Another opportunity, which is very actionable for, I think, most of the audience on this webinar today, is VC fund investing. And so with this approach, what you're doing is you're investing directly into venture capital funds that vision and purpose align with your company. Some of the benefits of that is that you're getting startup engagement and the financial returns from a venture investor. As an example, about half of the companies that are currently in Shadow's third fund are strategic LPs that are professional AEC firms. The advantage of this is that you're getting the expertise and guidance of the venture firm, which is greatly reducing the risk that's associated with venture investing. And we're also able to act as top of funnel deal managers. I'm sure most of you on this webinar right now are approached by startups consistently that are pitching the latest, greatest widget that's going to save you billions of dollars and completely disrupt the entire industry and innovate everything and for anyone. We know that's not the case, but when you work with us, we manage that top of the funnel. So we're able to go through, sort, and evaluate those startups and say, these ones are most strategically relevant for you, and these are the ones that you should actually be talking to, making sure that your time is really well used. The downside of this model is that not all of the investments that we make are going to be strategic specifically for you. We're a venture capital firm that invests in the built environment, so that's a good start. But we are also going to invest across the entire built environment. So we're going to look at construction tech, prop tech, design tech, infrastructure tech, clean tech. And if you're a general contractor, all of those are not going to be relevant to your specific company. So not all of the deals that we pursue are going to be strategically relevant to you. All right, deal by deal investing. This is, I think, again, a very actionable approach. And it's kind of a hybrid between launching a dedicated fund and the VC fund investing that I just covered. In this model, what happens is your firm should form some relationships with a couple venture capital firms that align with the types of areas that you're looking at getting involved with. So for an example, anytime Shadow invests in any company, we create what's called an SPV, which is a special purpose vehicle. And what that does is that it allows for sidecar investing from strategic investors to join us on the deal. So let's say Shadow has sourced, we've validated, we've underwritten, and we've negotiated an investment term sheet with a startup. We've agreed to invest $1 million in that startup. We will dedicate a percentage of that million for strategic investors to join us. So just as, example numbers, again, if we say we're going to invest $1 million in this startup, we might say 250,000 of that is going to come from Shadow's fund, and then we will go out and raise 750,000 from strategic investors that could form commercial relationships with that company. With that, another advantage is that once that investment is done, we're also going to manage every aspect of that company because they are one of our portfolio companies. So it's a very hands-off way for corporates to get involved with corporate venturing, but it's also a way for corporations to quickly receive the strategic and financial value of corporate venturing. In return, we charge typically about a 10% investment fee, and then we earn carry in that deal that ranges from 10 to 20%, kind of depending on what it is. The downside of this model is that you are going to be more exposed from a financial perspective. So what I mean by that is, like I said earlier, investing is risky, venture investing is risky, and typically the more deals you've done and the larger your portfolio is, the more you're de-risking that investment strategy because you have more chances of hitting home runs or hitting doubles and triples compared to if you're only invested in 2 companies, you're very exposed from a portfolio perspective. Slide 12 is one of my favorite models, and it's, again, something that's probably better to be growing into, but it's kind of a hybrid model between 2, 3, and 4. And really what you're doing here is you're picking the best aspects of each one. So within this, typically you would look to invest in 1 to 2 strategically aligned venture funds. Those venture funds are going to be investing for you, and they're going to be, helping create deal flow for your company. At the same time, saving some on the side to double down and invest in strategically relevant deals. So back to the deal by deal investing on slide 11. And so I think this is a pretty good hybrid model that eventually companies can start to look at. And again, this type of model can be executed with your existing team. And then the last one is something new. It's something that I don't know is 100% relevant for the audience here today, but it's something I continue to observe within the space. And it more looks like corporate private equity than corporate venturing. The reason I continue to see this trend bubble up is it's sometimes hard for the big multinational corporations to justify the financial value of corporate venturing. And what I mean by that is if you're a venture capital firm and you invest $1 million in a company and you get a 10x return, everybody's going out for a steak dinner and it's going to be a great party. But if you're a $1 billion corporation, a 10x return is a rounding error, and it's very hard to justify the financial model and the returns that you're getting given the time horizon associated with typical venture investing. So what corporate private equity starts to look like is it's more of an acquisition strategy where you are acquiring strategic companies that are smaller in size and rolling them up to create some sort of new business vertical. Again, probably not completely relevant to this audience today, but something that I think is really interesting and also kind of worth tracking over time.
There's a lot of great information that you shared. Thanks. What percentage of money from my company's overall net worth might be a good starting point to consider in corporate investing?
So I don't know about the percentage wise. I can give you an example of what it costs to work with Shadow, and every venture capital firm is different. But if you wanted to become a limited partner in a Shadow fund for a corporate, that's typically about $1 million. And that capital call is over 5 years. So it's $250,000 a year over 5 years. If you are a corporate and you want to do deal by deal investing with Shadow, the typical size of those is around 55,000 per deal, on the minimum of that.
And where can I go in terms of what other resources are available, either online or books, that can give me a little bit more information?
Yeah, so one of my favorite groups is called the Global Corporate Venturing and Innovation. It's GCVI, and it is, it's probably 200 or 300 different corporate venturing professionals. And once a year, they do a big meeting actually in California, where they all meet up, and it's a 3-day conference all around corporate venturing. You have to be a little bit careful at those events because sometimes it is, they're patting themselves on their own back, but it's a great learning experience, especially if you're looking at getting started. They have some really great panels and really strong panel discussions that go on there. But like I said, just take it with a grain of salt because it is corporate venturing people talking about how great corporate venturing is. So be aware.
All right. Thanks, Brian.
Awesome. So, what are some ways that you could potentially get involved? If you are interested in working with Shadow more closely, we do offer quite a few opportunities. Some are free, some involve investments. The first is investing in our fund. The second would be investing with us, which is the deal by deal strategic investing. So if any of you want to reach out to me afterwards and see kind of what Shadow has bubbling up in our pipeline, I'm happy to make those introductions and share any deals when they're relevant. The third is manager investing. So if you want to launch a fund but don't want to hire somebody to manage it for you, we are very experienced with that. Like I said, our first 2 funds were actually set up this way. A way to just get involved and kind of keep up with opportunities and kind of join our community. We have over 600 members right now that are a part of our Built Professional community. And that's just a simple Slack channel where we constantly feed updates that are happening in the industry and highlight some of the startups that we work with. You can work directly with startups. So any deal that Shadow invests in, we're looking for venture advisors, which would be strategically relevant individuals that can help us manage those startups and provide guidance to them. And there's no financial commitment from you all to be a part of that. And we do financially reward venture advisors for helping us. And then the last piece is top of funnel management. Send us the startups you work with. I mentioned this earlier, but I'm sure a lot of you are approached every single day by startups that are trying to get your business, and it can become a little bit overwhelming trying to figure out which ones you should actually partner with. So if you are coming across some that you think are, hey, these guys are kind of cool, I'm interested to see if what they're doing is relevant, shoot them our way. I'm happy to jump on a call with them and kind of go through what their business model is. We have a full-time CTO on our staff that'll go through a full tech diligence with them. And we'll be able to kind of quickly tell you if we think it's somebody that you should go forward with, or maybe if it's something that's not quite ready yet for a commercial agreement.
Great. That was so wonderful, Brian. Hey, we have a question here from Steve Burrows, who's actually someone who presented in one of CIDCI's first salons.
So, hey, Brian.
Hey, Steve.
Hey. So I had 2 questions, actually. So the first one was, what is the criteria that you use to assess the potential of startups? Because, that's a view into the future, right? How do you actually do that?
Yeah, we always joke that the Series A investors have it really easy because they can just look at revenue, look at growth, and then model that out in the future to figure out what the company's going to be worth. When we're working with seed stage companies, we don't have that luxury because a lot of them don't have any existing revenue. So like I said, it is very much looking into the future. There's kind of three basic criteria we look from the startup perspective. The first is the problem they're solving and how big is the problem that they're trying to solve. The second is the technology they've developed and the defensibility of that technology. And the third is the founding team's ability to execute on that strategy and on that vision. If they check those check boxes, we'll typically move them into a diligence process. And what's involved with that is us reaching out to our professional network and validating that what this company is doing is actually solving a problem, and that there's some sort of interest from those companies, maybe in an introduction, a pilot program, or forming a commercial agreement. So we actually try to stack up a number of potential customers for those companies before we invest, so that as soon as we do invest, we can quickly create value in terms of where we invested in that company compared to where we can take them.
Okay, and so that's good. And just a follow up to that, what size of investment what is the range of scale of investment that you make in the startups, and what multiple of valuation are you looking for the startup to achieve in what sort of time scale? So, what is the sort of pro forma for that? Yeah.
Yep. So we typically make check sizes anywhere from 250,000 to $1 million. It depends on the startup and what stage they are and how much they're looking to raise. Typically, we're looking to capture anywhere from 10 to 15% equity in the company with those investment sizes. So you can do pre and post valuation based on how much we invest and where they are to kind of figure out the general size that we look at. And our typical time horizon is actually a little bit different than a lot of venture capital firms. A lot of venture capital firms will invest early and they will stay in that company until there's hopefully an IPO or an eventual acquisition 10 years down the road. We actually take a little bit different approach, and we more focus on hitting doubles and triples. So we actually look to trade out our position with more institutional VCs around Series A, sometimes Series B. So typically we're looking for, for us, a good solid win is a 5 to 10x. A 3x is sometimes in our ballpark, and that can be anywhere from 18 to 24 months after the original investment.
Okay, thanks. It's very useful.
Great questions. If anybody wants to follow up directly, my email address is in the presentation. Feel free to reach out to me afterwards. I know I covered a lot kind of in a rapid fire approach, and it can kind of be a little bit overwhelming, but if any of you want to touch base one-on-one, happy to field those and kind of, walk you through maybe what you're thinking and then give a little bit of guidance on where maybe you should go.
Well, I think you've done an amazing job, Brian, and thank you so much, Zig, for popping in with lots of really great questions to help hold the conversation together. I think that we'll conclude CIDCI's online salon for today. Our next salon will be September 18th, featuring Forrest Flager from Katera. You can sign up to receive notifications of future salons by subscribing to CIDCI.org. Thank you for joining us. And as always, if you've got thoughts or comments, please feel free to reach out to us via CIDCI's website, contact us link. Special thanks to Monica Zwissler for keeping us on track, Zig Rubel for helping us frame the conversation, and especially to you, Brian, for a really terrific presentation. Thank you all so much for joining us. Be safe and see us soon.
Great. Thank you guys for having me.